You.
So let's go to Legacy Hack listeners and viewers, subscribers. Yours truly, Tyler McCart, coming at you. Very excited to be able to be with you again. And I hope you're not getting bored of our episodes. We try to make these interesting.
Never,
Uh,
Tyler.
I mean, Jack, I try to at least make them somewhat exciting. And because, we want to keep your attention. And, there is a little bit of an entertainment value with anything. I typically pay more attention whenever I get a bit of entertainment involved. But guys, like we always talk about, we want to educate you. We want to inform you with what the whole infinite banking concept is, how it works with your life, how you can benefit from it. Obviously, always we want to talk about the pitfalls with it. We're not just sitting there painting a bunch of, through rose-colored glasses, and we don't see the real reality of stuff. So again, we're here to make you aware of stuff. And again, Jack and I, we want to talk today about the top 5 myths about family banking. All right. So we're going to talk about these myths that are out there. Uh,
Myths
we,
busted.
yeah, myths busted exactly because we want to bust some of these myths up. But these some people, because Jack, your perception is your reality. Okay. And I remember a very, very wealthy dude telling me this, which it made a lot of sense then when he was telling me this. He said, Tyler, the stuff that you actually believe that's wrong is really the stuff that's messing you up. And I'm like, okay, that's really interesting. Not the stuff I
Hmm.
don't know about, but the stuff I do believe and know that is actually wrong that's really messing me up. And so I think today we can kind of hit on a couple of these things with that. So the very first one, and these are common. Okay, these are common. These are not like anything that's really deep or whatever, but these are common myths that we want to kind of knock out of the park and bust up today. So the first one that I have down here, Jack, is family banking is for the wealthy. All right. So take it away, Jack. Let's bust this sucker.
Yeah, this is an interesting one because I feel like all the biggest examples that are shared about the infinite banking concept come from those with more wealth. Like we talked about the Rockefellers last week. You got a Ray Kroc McDonald's example, a Walt Disney example, and those guys, yeah, actually like had whole life policies before they got big that served them well. But it can be easy to think this is like a special strategy that only the people who are in the know or are of more means use. But the reality is the numbers scale, whether it's a million a year someone's paying premium or 10,000 a year. You're
Mm,
gonna, if it's set up well, you're going to be able to have access to cash and build cash value that can serve as an opportunity fund that you can borrow against and use for the things that you have going on. And yeah, if there is more money up front because you have higher income or liquidity on hand, like you're going to be able to do more with it right away. um, but this is a valuable asset if set up and funded well up front that can serve someone their whole life. So it's not something that, yeah, that you're necessarily going to get max use out of day one. But starting it, planting the tree, and letting it grow and serve your financial life can work for anyone. That said, I'll give a caveat of I'm I'm of the mind that having like 10,000 a year of annual premium, if not a kid or juvenile policy, is about my minimum threshold for it to make sense to start. Just because if you have less than that, you're probably in a stage where it makes sense to, yeah, build out more reserves just for like emergency fund, or yeah, find ways to increase income before you're um, socking a good chunk into this, which yeah, it's still going to be accessible to you, but I think it can just serve you better when you cross that threshold of about 10,000 a year in premium.
Yeah, and I think that's a good, kind of benchmark right there, especially, if you're, and that was annual
Correct.
premium going in. Yeah. So you're not like, you're not breaking the bank at all. I mean, you're looking at what, that's less than $1,000 a month,
Yep.
that you're actually contributing into, say, said, your bank. I'm gonna, since I'm literally just got done here, whatever, but yesterday. So my thing is, Jack, is I'm gonna take it a step even further back of actually not even having to work with someone that's like ultra wealthy and just starting. And that is actually the power of the term policy. Okay. And, like, for example, one of my clients that I have right now, he's a single guy. He does outside sales. And, when I first sat down with him, we'll call him Joe, said, Joe, let's look at your finances, look where, because he got really excited about the whole, infinite banking, having my own bank and being able to create some generational wealth long term for himself. And I said, well, let's look at your finances. That's the first step, really, is let's look at kind of what's going on with you right now. And quite honestly, when we sat down with him and looked at everything, uh, his finances were a little bit off. He wasn't making as much income as what he needed to make. He didn't have hardly anything in savings. He had a couple credit cards that were actually one credit card that he had. And so I said, well, buddy, I'm not going to sit there and recommend that we go into this whole family banking or infinite banking thing and you start to try to fund a policy, but you still need to start. And he bought into that process of saying, okay, we'll start. And so we're going to start with this whole term policy thing. So we at least get a health rating at the most insurable age that you're at right now, which I think at that time he was 32. And from that, he was able to get a $2.5 million term policy. Okay. And it was a really is it a great monthly payment that he needed to have. And then once we issued that to him, we went into basically because what takes place with term, and Jack, you're a whole lot better of an expert than I am. But when you have a term policy, you can actually convert that into a permanent policy, and that's ultimately what we want to do with our actually bank is we want to actually get into that permanent cash value life insurance policy. So Joe now has a game plan with me. I meet with him right at now every 90 days. He just sends me an update on his financial review. Okay. And he's letting me see we have certain goals. Like literally, we have a goal of him actually paying down some of his credit card and actually having about $10,000 actually in a savings account. Okay. Which he can do that really pretty quickly. He just needed to get control of the finances and start being disciplined with that. But, we've got this plan in place, to be able to do that. And I think that, again, you don't have to be wealthy. You just have to start, right? I mean, that's the whole thing that people sit there and get so wrapped around the axle, like, oh, I've got to have like, $1 million worth of, liquidity just sitting around doing nothing. Well, if you got $1 million just sitting around doing nothing, maybe you might not be a good candidate anyway. But I'll still help you out, okay? Right? But it's more about having a system of being disciplined than actually being rich. I would say, Jack. So
Yeah.
that's kind of a little bit of my take on that right there on that myth. Anything you want to add to that before we move on?
Nope, I think that's great. I love, yeah, like preparing to start before you start
Mm,
if the house isn't in order yet. I think that's a great principle.
yep. So myth number two. Here we go, Jack. This is what I got on my list right here. See, I lose access to my money if I put it in a policy. Jack, there's a lot of ways we go with this, but let's go for it,
Yeah,
man.
you
You ready
could lose
for it?
money. Um,
Yeah. Oh, yeah, that's true. You could. Yep. Depends
yep.
on how you
If
design
it's
it.
yeah, like the I mean, I've come across, I won't say the carrier, but most everyone has a cousin or a college buddy who works with this large insurance company who has sold them a policy when they were young, and often a whole life policy that builds cash value very slowly. And like in our example of funding 10,000 of premium a year one, you'd have $0 of cash value if it's a what's called base only setup of a whole life policy. Um, so we, yeah, and the reality is year one, likely with any policy design, you'll lose access to a small portion of the premium that you pay in year one.
And
And
let
it's,
me just real quick, Jack. Let me
yep,
cut you off, but let me just speak to that real quick because that is kind of a little bit of a hang up that I've had people sit there and say. And the thing that helped me when I was starting up, this whole family banking thing, that what Ryan kind of coached me on, that said, hey Tyler, you're actually going to see a little bit less in cash value in the beginning than you will like after year three or year four. And the way Ryan kind of told me is like, look, the way the mindset you kind of approach it with is you're starting a business. You know, if you feel like you're going to turn a profit from day one in any business, there's no way in the world you're going to do that. And that's something that Ryan kind of helped me out with. Usually by year three or four, you are going to turn a profit with the business. So that's that's just kind of what you're talking about right there, Jack. Kind of helped me
yep,
out with that.
yeah, totally. And yeah, I mean, it's true when you buy a house, like you pay closing costs that don't
Mm-hmm.
go to anything that gives you access to it. Yeah, with a business, like you're gonna be buying it and then reinvesting in it to make it better. So yeah, same principle with this. That said, we structure it either whole life or index universal life to give you maximum access to cash from day one, and that can be, I'd say, anywhere between like 75 to 90% that depending on if it's whole life or IUL, that a client could borrow back out like days after issuing the policy if they need to. So we are retaining access to the majority of what you pay in year one, and that's by design because we want this to be a tool that is a cash equivalent and liquidity tool for you, your pool of capital that is going to grow long term and be accessible long term. So
So underneath that, Jack, I want you to kind of also unpack a little bit, comparing it to how it looks, versus a CD or 401k as well,
yeah,
because there's different restrictions to those right there that kind of are similar but different,
yep.
with this. So yeah,
Yeah. I mean, I believe a CD is locked for whatever term you get the
yep,
interest rate for 3, 6, 12, 2 years.
yep,
So that money becomes inaccessible during that time. And then you're going to pay taxes on the interest that you earn on it. A 401k, I actually just looked at a 401k today that had a loan against it. But yeah, the loan terms, I think you can only ever access about 50% of your account balance in a
hmm,
401k via a
yeah.
loan. And then paying that loan back is there's definitely more defined terms and stricter timeline with most 401k providers. And then in the bigger picture, like you really shouldn't be accessing that until 59 and a half for
Yep.
retirement income. Like that is the sole purpose of a 401k, is to build an account balance that can replace income in retirement. So yeah, you're losing access to that cash for maybe 35 plus years, depending on when you start it and when you retire. So, in comparison, you're losing access to very little of your cash with a properly designed permanent life insurance policy.
Yeah, I think the key words right there is a properly designed. Because, like, for example, I'm working with a gentleman right now that, he's got about $70,000 in a policy currently, um, but it's only he can access it, but the loan rate is like at 8%, and the internal rate of return is only at 2%.
Hmm.
And so the design inside the policy it doesn't lend to that. So that's why the properly designed policy is critical in how you don't lose access to your money. So yeah, so
Yep.
that's
And I,
Mythbuster number two that we have right there, Jack.
yeah.
Anything else?
And I will say, like, design for what you want to accomplish. Most of our
Mm,
clients want early access to cash value so they can like have those dollars grown in there and be put to work in something else profitable that they're up to. If it's, yeah, and in an estate planning circumstance where you want the largest death benefit possible, like it could be that the design is to have very little or no cash value up front. So,
yeah,
yeah, a policy is very moldable to do what you want to do. You just want to make sure it's molded to do what you want to do, and who you're working with agent wise plays a big
right.
role in that.
Yeah. Yeah. I resound everything you're saying because it definitely house design, who you're working with, um, because like even myself, even though I'm actually doing it now, I'm actually having to get ready to make, some deposits into my kids' uh, policies. But I needed Ryan, the gentleman that actually works with me, to walk me through some different things that I just needed to see because he sees things that I just didn't see. So even having the right person involved with it is critical, so critical.
Yep.
All right, let's move on. Number three, it's too expensive. This whole thing is just too expensive.
Hmm.
So, Jack, you wanna take that one first? You want me to kind of take a stab at it?
I can take a swing. Whether it's term insurance, permanent life insurance, disability insurance, the cost that you're paying for it is exactly what it should be based on
Hmm.
the risk, the timeline. Um, so yeah, like it's that at face value isn't a good enough excuse. It's or not excuse, but objection. Um, but that said, like the cost of insurance on a policy, which we've kind of alluded to, like in the 10,000 a year example, like your cost of insurance can be 10,000 a year, or it could be $50 year one on an IUL,
Hmm.
and you could
Yeah.
have the majority of that premium going towards cash value, which is the portion of the death benefit that is accessible to you and earns index credits or a dividend on each year. Um, so it's all relative, but yeah, like the premium should be much more expensive if it's guaranteeing a payout and yeah, like covering your whole life rather than 98% of term policies don't have an insured that dies during the term. So that should be much cheaper because most of the time you aren't going to get a benefit besides peace of mind of being covered during that term. So
Yeah. I would
yeah.
even go. I would even say, I think you kind of said it just a second ago. Is kind of the mindset you're approaching this with. As far as an expense. you know, now that I'm actually on the other side, and even whenever I was doing my research in the beginning, you know, I looked at this as and I don't want to say an investment, but a way to actually store or have a saving system for the money that I had or my wealth that I was accumulating in a safe place. Because I mean, what is it like? The carriers, some of the carriers we work with have been around for over 150 years, and so there's a lot more security with that, knowing that. And the other thing with it is you know I I don't know why we kind of beat up on traditional banks, but a traditional bank is already making way more interest off of you than, and that's pretty expensive if you look at it from that perspective, right, Jack? I mean,
Mm-hmm.
now all of a sudden you're paying yourself the interest versus it going to an outside bank. So the real cost is not actually dependent upon an outside bank, which is taking advantage of your money that is only that they're loaning it out to all these people and making so much more, fractional interest off of that versus you. And so it kind of just has to be a mindset shift in, what is expensive.
Mm-hmm.
So
Yep.
it's interesting. It's an interesting way to look at it. I think, if you look at it from a business owner standpoint, you know, like me, like for example, like I'm right now in the process of actually with my kids' policies. I don't look at that as a expense that I have to make for those policies. I look at it as a deposit
Mm-hmm.
into my bank. Okay, that now starts to generate interest on that money that was just sitting idle or that was in say a said you know uh vehicle that wasn't generating as much of a return on it, and now it's going into a new vehicle, into the prime vehicle, which has multiple things going for it. Number one, obviously it's generating something inside for that cash value, and now even my kids, they can actually borrow against it if they need to in the future. And number three, guess what? There's a death benefit. In case they do graduate from this earth, right there. So the expensive part is kind of a tough one for me to swallow
Mm-hmm.
as far as looking at it. So yeah.
Yep. That's good.
All right. Myth number 4. It's just insurance, Jack. Just insurance.
Oh, not so fast. Um, Term insurance is just insurance, I'd say.
Yeah.
Just a death benefit in case of dying too early in an untimely fashion. Permanent life insurance just has so many other components to it that it goes beyond insurance. Still, at its core, it's providing a death benefit that lasts your whole life. Um, but when you talk about cash value, a portion of the death benefit that you have access to while you're living, that's a current benefit. That's we've kind of referred to like when I applied for my home mortgage, like my cash value was a cash equivalent in their eyes that gave me more liquidity on hand and a better rate. When you apply for financial aid for a kid's college, this is a private life insurance is a private contract that does not show up on your net worth statement, so is not accounted for, and you could qualify for financial aid for your kid that you don't really need or deserve potentially. Um, it can provide long-term care and an acceleration of the death benefit if you're critically, chronically, or terminally
Mm.
ill.
That's a pretty big one right there too, Jack, that most people don't realize
Mm-hmm,
is kind of the thing they don't is like if you did get critical or chronically ill or whatever, they can take advantage of that, you
mm-hmm.
know, as an early portion of the death benefit, which is huge.
Yep, yep. Similar to the FAFSA deal, it's creditor protected if it's personally owned, and the
Mm.
amount of it that is varies by state. But that safeguards your assets if you get sued for some reason. Um,
Yeah.
and then just to like what infinite banking is about is that it's an opportunity fund to borrow against and put your dollars to work in multiple ways at the same time. So really it's a banking vehicle if it's structured that way and used that way. So goes far beyond life insurance is the tool that we use for this.
Yeah.
But it touches much more than just a death benefit that most people think of as insurance.
Yeah. I mean, I 100% agree with you. I mean, you couldn't have said it better on that, Jack, is because, yeah, you can just own, like, again, I'll go back to one of the gentlemen that, he's got a term policy and he's got this, it's called a universal life insurance policy. So it's not an IUS, it's universal life. And it is really all it is just insurance. And that's it. He he really doesn't have it structured to be able, the UL doesn't have the structure to be able to borrow against it or to use it as a banking function. I mean, he could, I guess I shouldn't say it. He could if he really wanted to, but it probably wouldn't be the smartest thing to do. And I probably would venture to say the person he's working with that wouldn't even know how to go about that. Maybe I mean I shouldn't probably say that, but you can use it just for pure death benefit, and that's what insurance is. It's just that if you just look at it from a pure standpoint of that. But again, like you were saying, it limits you to this opportunity, to have kind of a banking function, for what it is, where you've got protection, you've got guaranteed growth going on inside your policy, you've got liquidity access that you can get to, and then, you also get this legacy thing. So it's more than just life insurance. Okay.
Mm-hmm. Yeah.
Um, and, again, I, I, I think that, instead of just looking at just buying insurance, you know, you're actually creating a system that you're starting to open up. And so that's why this is just a myth that might be out there, but you have to expand your mindset with it. So yeah. Anything else you want to add to that, Jack?
Yeah, and I feel like you were somewhat hinting at this too, but just like back in a kind of traditional mindset that people have with money. This is a post I saw today from one of the guys who is like the most, I don't know, visible financial advisors on LinkedIn. And he's talking about create a volatility buffer account with 3 to 5 years of projected retirement income. Um,
Mm,
and
interesting.
like he's referring to a permanent life insurance policy. I know kind of how he does his planning. And yeah, when markets crash, we use a volatility buffer account for your income in retirement. Your investments stay untouched, allowing for long-term growth. So that's just another thing that this does that is not insurance. Well,
Yeah,
it's insurance against a market crash.
that's exactly what it is. You're
Yeah.
insuring against the market crash. That's the way we put it, Jack.
Yeah. So covers a lot of
Oh.
bases.
All right, here's the last one, Jack, that I've got. Myth number 5. The bank is better. Ooh,
Hmm.
the bank is better. So I'll
Yeah.
let you start it off, Jack.
Yeah, this is interesting. Like I think it's saying like a bank account is better to use than the cash
Mm-hmm.
value of life insurance. And
Yep.
for some things it is. Like paying your monthly expenses, a bank is better. It's easier transaction wise, like it's great for covering monthly expenses. But in the big picture, I think we pulled up this slide the other day. I'll just throw it up again for a visual. This is Bank of America's stats from a recent year on uh, if you deposit $1,000 in the bank, Bank of America on average is paying their depositors 0.2% in interest. And then because of fractional reserve banking, they only need to keep 100 of your dollars in the bank and they can loan out the rest. And on that rest, they were loaning out on average at 5.2%. So that earns them, that means they pay $2 to make $46.80, which is a wonderful rate of return for this financial institution, their owners. So yeah, our question is always, what if we could be the owner of that system? What if we
Yeah.
could create our own pool of capital that we can borrow against and use when we need to, but can kind of honor our dollar's ability to grow for our whole life, even when we do use it. So that's one component of this. I'd say also just the safety of life insurance cash value. Like we know from our primary carrier's chief investment officer that if every single policyholder of theirs died at one time, they'd be able to pay out every single death benefit and still have money left over. Whereas with Bank of America, if not even all of their bank account holders, but a good chunk of them ask for their money at the same time, it would not be there because it's all loaned out in different deals. And that would be called a run on the banks. And then you would need some FDIC insurance for up to $250,000 on your account. But the FDIC reserve only covers about, I think, like 2 to 3% of all bank account balances that are held across the US. So it's quite fragile of a system, the banking system in the United States. And I much prefer to keep my liquidity with the cash value of mutual life insurance carriers.
Well, I just when you start using that example, Jack, I go back to the movie It's a Wonderful Life. And, during those, times right there, they had that called run on the bank.
Mm-hmm.
And, they're trying to keep their doors open and they have these like two little, I think they had $2 left. And, they're like, let's put them in the bank, in the vault over here. And they see if they can make some more little things, little dollars, but you're right. I mean, it kind of goes back to you know how much control and how much money do you want to actually create. I mean, your slide that you showed of that well-known Bank of America, that at how much actually they're making. I mean, to was it 2,000%, now you're not going to make that in your own infinite banking, family banking. You're not going to make that. Okay. But you're going to make a whole lot more for yourself and for your family. And the other thing that I like to, I don't know why the analogy always just helps me out with this. Again, it goes back to, I know we probably hit on, as far as the interest, we've kind of hit on that pretty hard. But again, I like to go back to the system. And the system part is you actually being in control of how you pay back and when you pay back and what that means. You actually determine, quote unquote, the rules of that system, right?
Mm-hmm. Yeah,
And I
that's
mean,
big.
the analogy that I like to think about is, you know, like I think I've used it before, but you go down the street because I live in a community and we have our pool, okay, and the community pool, everybody can go to the community pool that's in the community, okay. Um, well, the community pool here in the next couple days here in Georgia is going to be shut down. You can't go to that pool. Okay, so it has a rule. All right. It also has rules of adult swim, or it has rules of you can't run, or whenever you can't run on the sidewalk. You can't throw certain items in the pool. There's all these rules that pool has. But what kind of the analogy is actually, what if you had your own pool in your own backyard? well, then you can have your own rules. You can determine what you want and not what somebody else that has access to all this over here needs to have. And so that's kind of the again that mindset shift, okay, uh, that we need to have is you actually are in control. You actually make the rules. Now there are certain guidelines and certain things that the insurance carrier has, and that's totally fine if you understand what their system and how they work. But then you determine how you're going to pay it back. You know how much interest you might want to charge, say, someone else if you loan out something to them. All these things you actually become control of with it. So that's why I feel like again this is a better banking system, in my opinion, Jack.
Yep,
Right?
I agree.
So, yeah. Well, Jack, that's the five myth busters that we just went through. Um, any last kind of parting thoughts or that you'd like to kind of add? I'm going to do a recap at the end of them, plus the truths. But any kind of thoughts with it all, Jack?
Yeah, I guess just to say that we aren't saying don't use a bank account. You need bank accounts to operate in the US. Um, but in terms of a high yield savings account replacement or something like that, I mean, I have a high yield savings account too, but like the bigger chunk of my liquidity is going into this vehicle. And yeah, I have some people come to me and say, can I put like my whole income into this and pay for all my expenses through this? And there are some IBC guys who will show, oh, that is possible, like probably a few years in. But that's very, very hands-on, unless you have a bank line of credit against your cash value that just makes it more accessible, less delays and policy loans going out and stuff. So I'll just throw that out there. This is a savings enhancer, not a complete bank account replacement.
Yeah. No, I totally agree with you, Jack. I think that, you know, we're not we're not saying totally disregard the system that currently majority of people know of that are out there. Um, but I do believe that again, if you want control, if you actually want to actually, generate some wealth versus someone else generating a whole lot more interest or wealth off of you, this is something that you can really take advantage of. And, you know, at the end of the day, you know, it's again, we keep coming back to this is a system, this is a business, this is something that, it's not a set it and forget it type thing. So it does require a little bit more of your brain to actually think through. Sorry, this is why maybe it's not for a lot of people, but these myths that are out there of, you know, it's only for the wealthy, or you're going to lose access to the money you put in the policy, or it's too expensive, or yeah, it's just life insurance, or the bank is better. All these are just myths, okay, that are out there that I feel like today we did a pretty good job, Jack, of actually debunking and really putting holes in it, and I feel good about that. So, legacy hack, folks. Here's what I'll tell you guys. You know, Jack and I and Kyle, we're here to help you. Okay, we're here to. I've got a gentleman right now that he's got questions about, the whole death benefit and the cash value, and I'm going to be open a can of worms with this, but why can't the death benefit and the cash value come out too, Tyler? Why can't I have both? All right. And so I'm having to help him through that of understanding. And again, this is a process of understanding and help you educate you so you make an informed decision about, whether this is right for you. But also, Jack and myself and Kyle, we're here once you actually do actually execute and, have your own bank, whether it be a term policy like I talked about in the beginning, or you actually do have a permanent life insurance policy that's cash value funded and properly designed, that you have someone there walking you through the process, just like I did today. I had Ryan on a Zoom call. We were going through my financial things. We were looking at all the different things that I have going on, where money's at, where money might need to be moved. But again, I've got Ryan there to help me through that process. And that's what we're here for. That's what we want to be here for. Okay. So, Jack, you good with everything, buddy?
Yep, that was a good one.
All right, man. Well, hey, Legacy Hack, please, if last thing I'll ask you to do, if you did find this interesting, okay, you found it beneficial, and you thought of somebody, share this with them. Not with 10 people. You don't have to blast this out on social media or anything. Just send this to one person. That's all I'm asking you to do. Send it to one person that you thought of and say, hey, I thought about you whenever I was watching this here, and I think you might be a benefit to just one person, not 10, just one. Okay. So, Legacy Hack, y'all have a great one, and we'll catch you on the other side.